Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I am the Chief Strategist here at Options Play. And today what we're going to talk about is maximizing profits with debit and credit vertical spreads. Now, I want to do this topic because these are strategies that we utilize here at Options Play heavily, yet I tend to get a lot of questions from users asking whether they should trade debit versus credit spread. And I also see a fair amount of commentary out there from the questions that are asked and the research that is out there that suggests that you should trade debit versus credit spreads depending on implied volatility. Yet, these two strategies are so different in nature, they really shouldn't even be compared to each other because they are used for completely different market outlooks. So today, what I actually want to spend the time here today is not actually comparing debit versus credit spreads. What I actually want to do is actually show you how different they are in nature by breaking them down into their components, and then helping you understand when you should use debit spreads and when you should use credit spreads so that you're actually deploying your capital efficiently, as opposed to sometimes if you use certain indicators like volatility to decide which strategy you should trade, you can actually be trading a fairly suboptimal strategy. So today what I want to do is I want to break down these strategies and show you the difference, hopefully in a way that perhaps has never been presented in this specific way. So let's go ahead and get started. Before I do, just a little bit of housekeeping. The platform that I'll show you here today to teach you how to analyze debit versus credit spreads is available as a free trial for those of you that don't have access to Options Play. You can sign up using this link here at the bottom, which gives you access to a 30-day free trial. Membership is just $75 a month or $500 a year. And this gives you a 12-step options trading course to help you get started for those of you that are brand new to options trading, as well as daily options trading ideas, such as the debit spreads that we send out every morning. So with that, if you're brand new, welcome. Hopefully this webinar is helpful. I will say that what I'm going to cover here today is not actually an in-depth understanding of debit versus credit spreads, because if you want to learn more about those strategies themselves and best practices and trading those strategies, I actually have separate recorded webinars just on those strategies alone. So this is more of an overview of the two strategies, showing you how different they are in nature. And then if you want to learn more about each specific one, I highly recommend you to take a look at some of our previously recorded webinars, which I will send a link in the slides. So let's go ahead and get started. Today, what I want to define are what are vertical spreads. So for those of you that are brand new to options trading, I want to first talk about what vertical spreads are. Then what we're going to do is we're going to break them down from debit versus credit before we talk about when should you utilize vertical spreads. When should you utilize debit spreads, when should you utilize credit spreads, and then go through as many examples as possible, because I think that's the best way to truly learn. Now, before I get started, I just want to get a quick glance at the audience here. Now, if you can please bring up your chat window at the bottom of your screen. Please type 1 if you're familiar with vertical spreads or you're familiar with debit versus credit spreads, and please type 2 if you are unfamiliar with this type of strategy, or you're not, you don't know what a credit or vertical spread is. Okay, so I see a lot of 1s, a fair amount of 2s as well. So for those of you that are 1s, I really hope that this illuminates truly the difference between these two strategies, because they fundamentally are quite different from each other. For those of you that responded 2, meaning you're brand new to these strategies, I hope that this provides you with a new way to consider how to utilize options, because debit versus credit spreads are really just an improvement of buying calls and puts and selling calls and puts. So if you understand calls and puts, you should be able to understand debit and credit spreads. So let's go ahead and get started. Effectively, vertical spreads are two-leg trades, meaning you're always going to buy one strike and sell another strike. Now, you can buy calls and puts in different combinations to create bullish and bearish vertical spreads, either a debit or a credit. So there's 4 different vertical spreads that you can trade. Today, what we're going to do is we're going to break down each one to its individual components so that you can have a better understanding as to why you want to trade each one. And once we actually break them down to its individual components, I think you'll see how different they truly are. So first off, what we're going to do is we're going to start off by talking about the calls, just call options. Because to truly understand the difference between a debit versus credit spread, we need to first understand the difference between buying a call and selling a call option. Once we understand that, that's when it will make a lot more sense as to why they're so different from each other, because debit versus credit spreads are so different from each other. It's like the difference between buying a call versus selling a call. They are very different in nature, they have very different risk profiles, and you would do them in very different market outlooks. So let's talk about buying a call versus selling a call. So first of all, when we buy a call, this is what we consider a bullish strategy. So I have an example here, a stock that's currently trading at $100. If I'm bullish on it, what I might do is I might buy a call option, and let's say that call option cost me $4. Conversely, on the other side of that trade, someone has to sell me that call option. So that person on the other side sells me that call option for $4. That person is neutral or mildly bearish on this particular trade. And what I want to do is I want to graphically show you the fundamental difference between these 2 trades on the next slide. But before I do, it's really important to understand that when you're buying a call, you have what we consider limited risk, because no matter what happens, the most you can lose is the $4 that you paid for that call option. Yet at the same time, you have unlimited rewards, because as long as the stock keeps going higher and higher, you're going to keep making more and more money on that call option. On the flip side, the person who sold you that call actually has unlimited risk, because in the event that the stock rallies, that person who sold you the call will lose more and more money. Yet, on the same token, the person who sold you that call, the maximum profit they can make is the $4 that they sold you the call option on. So fundamentally, these 2, the buyer of the call and the seller of the call, have very, very different outlooks and have very different risk profiles. And that is fundamentally the difference between buying a call versus selling a call. And that's actually the fundamental difference between a debit versus credit spread. And I'll show you that in a second. So I think the best way to illustrate this is actually looking at a chart. So here is a stock trading just around $100. And what I want to show you is, if you're a call buyer, meaning you're bullish on the stock and you're going to go out and buy a call, what you're effectively expressing is that you believe this stock is going to reach at least $104, because a $100 call option plus the $4 you pay means that you must believe that the stock is going to make a decent sized move to the upside in order for you to be profitable. So you would only buy a call option if you believe the stock is going to move at least 5, 6, 7, 8% in order for it to make sense to buy a call option. Now, if that makes sense to you, please type 3 into the chat window that in order to buy a call option, you need to believe that the stock is going to make a decent sized move to the upside in order for you to buy a call option. Great, so I see a lot of 3s. Now, flip that on a dime. The person who sold you that call has the exact opposite view. The person who sold you the call believes that the stock is going to stay below that 104 strike. So the person who sold you a 100 strike call, they collect $4. They have effectively $4 in upside. So if the stock goes up to 104, they break even. If the stock is at $100, they keep the $4. Anything below $100, they keep the $4. Now, what's interesting about a call seller is that in all of these possibilities that I have on my screen, they make the exact same amount of money. They make $4. It doesn't matter if the stock stays at 100, goes to 96, or even goes all the way to 0. The most they make is the $4 that they've sold you the call for. Now, in the event the stock takes off, that's when the call seller loses money. And the more it goes higher, the more money they lose. So it's the exact opposite risk profile of a call buyer. Conversely, that call buyer, it doesn't matter whether the stock is here, 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 or here, they lose $4. It's only if the stock moves higher do they start making money. But the more it goes further, the more money they make. So that is the fundamental difference between buying a call versus selling a call. And this is going to come into play on the next slide when I teach you more about debit versus credit. Next, what I want to just cover before we move on to debit versus credit is just looking at the put side. The put side is pretty straightforward as well. You would buy a put if you're bearish. So let's say you would buy a 100 strike put for $4. That's a bearish trade. But the person on the flip side, the person who sold you that put, is neutral or mildly bullish. So someone that sells you that put for $4 is actually neutral or mildly bullish. And just like the calls, when you buy a put, you have limited risk and you have unlimited reward. So as long as the stock keeps moving lower and lower all the way down to zero, you're going to make more and more money. When you sell a put, you unfortunately have unlimited risk. Well, technically risk all the way down to zero, but I consider that unlimited risk, because if you sold a 100 strike put and the stock goes to zero, you lose $100 a share. You also have cap rewards, because the most you can make is the $4 that you make from selling that put. So just to reiterate again, using a chart, the best way to, I think, to learn buying a put and selling a put is to look at a chart. So I have the same chart here, but now, for a put option, I would only buy a put option if I believe the stock is going to move lower. And then not only do I have to believe it's going to move lower, I have to believe it's going to move lower by at least $4, because that's how much I'm paying for that put option. So I have to believe the stock might move down to maybe 95, 94, 93, 92, 91, 90 in order for it to make sense for me to buy a put. And the good thing about buying a put is that no matter what happens, even if the stock goes all the way up to 120, the most I risk is the $4 that I pay for that put. Conversely, for the put seller, they believe that the stock is not going to go below 96. They basically believe the stock is going to stay above 96. And the risk profile of a put seller is quite different, because it doesn't matter if the stock ends up here, 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 or here. The most they'll make is the $4 that they sold you the put for. But if the stock does decline, they will lose more and more money, because when they sell a put, they have to effectively buy the stock from you at 96, even if the stock is only worth 50 bucks. So the more the stock goes lower, the more they lose. Now, if this concept of the difference between a buyer and seller makes sense to you, please type 4 into the chat window, because it's absolutely critical that you understand this part in order to understand the difference between a credit versus a debit spread. Okay, great. I see a lot of 4s. Whoops. So with that, if you understand the difference between buying a call and selling a call versus buying a put versus selling a put, then the process of understanding debit versus credit spreads is going to be relatively easy, because a debit and credit spread are simply just slight improvements to just simply buying or selling a call or a put option. And the way you want to think about this is debit spreads are simply just cheaper versions of being long the call or put. Because in that example before, we talked about buying a call option if we're bullish, and we talked about buying a put if we're bearish. Now, in both of those examples, we suggested that that put cost about $4, which means that it would cost me $4 to buy unlimited upside or $4 to buy unlimited downside. Now, in reality, when we're buying a call option or a put option, we don't actually truly believe the stock is going to go to infinity or it's going to go all the way down to zero between now and the expiration date. That's why it doesn't always make sense to buy that unlimited upside. So what can we do? How can we improve our call and put buying? That's where a debit spread comes into play. Because what we can do is we can sell off some of that unlimited upside. So let's say instead of just outright buying a 100 strike call for $4, I'm going to at the same time also sell a 110 call against that for, let's say, just $1. And what that does is I'm basically saying I'm bullish on stock XYZ. I think it's going to go higher, but I don't really think it's going to go above 110 at the expiration date. And for that, I can collect some money. So what that means is now I can buy that upside instead of for $4, I can now buy it for $3. So what that means is I'm lowering my risk, I'm lowering my capital outlay, so that if I'm right on the trade, I actually make more money on the trade. Now, if that makes sense to you, please type 5 into the chat window. I just want to make sure that everyone understands why a debit spread is a cheaper version of buying a call or a put before we move on, because it's important that that's understood. Okay, so what you're trying to do is you're trying to buy that upside, but because we don't think it's going to go all the way to infinity, let's not pay for all that upside. Let's sell some of that off. Allow us to buy that upside for a cheaper price. So instead of paying $4, I only have to pay $3. Great, a lot of fives, which is fantastic. So flip that on a dime. If I'm trying to buy downside because I think the stock's going to move lower, I can buy a 100 strike put for $4, but I don't think the stock's going to go to zero. So why am I paying for all that upside? You can sell a lower put for just, let's say, $1 and collect $1 for that. So now you can buy the downside. Instead of for $4, you're buying it for $3. That means you have less risk. That means you have to put up less capital to trade. And there are some other benefits that I talk about on my webinar on debit spreads, but I'm not going to get into that today. What you really want to think about is debit spreads are just a cheaper version of buying a call or a put option, which gives you that directional exposure with limited risk. Okay, so if everyone understands that, that is why we want to trade debit spreads. So you want to trade debit spreads when you basically think the stock is going to make a move to the upside or to the downside, and you want to do it with limited risk. That's when you want to use a debit spread. Now let's think about the other side. Now let's talk about selling calls and puts. So remember, when we're selling a call, that's when we believe the stock is going to stay below a certain level. So if the stock is currently at $100 and I sell a put for $4, that basically means I don't think the stock is going to move much higher. I actually think it might be moving somewhere in this range. Now, the reason, one of the things you have to also consider is that if you really believe the stock is going to move significantly lower, it's actually better to buy the put than to actually sell a call. Because again, when you buy a put, the further it goes down, the more money you make. When you sell a call, you make the same amount of money. It doesn't matter whether the stock is at 100 or 99 or 0. You just make $4. So that's why I want to make sure that everyone understands the difference between buying a put and selling a call. Now, the reason that you don't want to just sell a call is because in the example that I showed you here before, if you sold the call and the stock takes off and the stock goes all the way up to 132, you lose more and more money. That's not a position that you really want to be in. So if you think the stock is going to stay below 104 and you want to sell a call, and selling a call option is great because if the stock doesn't move, you can make $4 from the stock not moving. That's something you can't do with anything else. But you're taking on this risk that if the stock does take off, you have unlimited risk. That's not a position that you necessarily want to put yourself into. That's why you want to trade a credit spread, because a credit spread allows you to sell the same call for $4 and keep that risk profile so that if the stock stays neutral, you make some money, but you don't want that unlimited risk. So what you do is you actually buy a higher call for just $1, and what that does is it caps your risk so that no matter what happens, you cannot lose more than the difference between these two strikes, which is 110 and 100, minus the $3 that you actually receive in credit. So the maximum risk you're actually taking now is just $7 as opposed to unlimited. That's why you want to trade a credit spread, because you want to short a call or a put, but you don't want to do it with unlimited risk. So a credit spread is really just helping you cap the risk of a short call or a short put. Now, if that concept makes sense to you, please type 6 into the chat window. Now, I know that takes a little bit of time to wrap your head around, so I want to make sure that everyone understands before I move on. Okay, great. I see a lot of 6s. Great. Perfect. Now, if let's say you sell a put option for $4. So in the put option case, as we were seeing here before, when you're selling a put, you're selling a put because you believe the stock is going to be somewhere in this range. You think it's going to be maybe a little lower, but you certainly don't believe it's going to do this, because if you think it's going to do that, you're better off buying a call option. And I think that's really one of the distinctions that I think that I want people to understand, is that yes, you can sell a put if you think it's going to do this, but you're not going to make nearly as much money as if you just bought the call option. Does that make sense to everyone? If that distinction makes sense, please type 7 into the chat window. That clearly, yes, you can make money buying selling a put if the stock moves higher, but you're making a fraction of what you would make if you had instead bought a call option. And again, that's the difference between selling a put, which is the equivalent of a credit spread, versus buying the call, which is the equivalent of a debit spread. Okay, so great, a lot of 7s, perfect. That's exactly what I wanted to hear. Let's see, let's go back. So, short put vertical. Selling a put, certainly useful if you think the stock's not going to move very much and you have a mildly bullish view. But selling a put puts you at a lot of risk, because if you sell a 100 strike put for $4 and the stock goes to 0, then guess what? You lose $96 a share. You're risking $96 a share to make $4. That's not a position that I generally recommend you to be in. So that's why you can buy a lower put for, let's say, $1, which means that instead of selling the put for $4, you're selling the credit spread for just $3. So you've reduced your income by $1, but you've capped your risk at just $7, because the difference between 100 and 90 is $10 minus the $3 income that you received. Then your max risk is just $7. So even if the stock goes all the way to 0, you're only losing $7, not $96. Does that make sense? You're giving up $1 in exchange for capping your risk from $96 down to just $7. If that makes sense, please type 8 into the chat window. I know I've asked a lot of questions for confirmation, but it's so important that you understand every single step before I move on. So perfect. I see a lot of 8s. So that's predominantly the questions that I'll be asking. And this one person asked $7. Yes, $7, because the difference between the two strikes, the difference between the 100 strike and the $90 strike is $10. Here it's $10, right? And because you sold the put for $4 and you bought it for $1, that means you're collecting a total of $3 in income. And the difference between 10 and 3 is $7. That's your max risk on a credit spread. Difference between the two strikes minus the income that you receive, that is the $7 that you are actually risking. And the whole point is that instead of risking $4, instead of making $4 while risking 96, you're basically making $3 while risking 7. That's a far better risk to reward ratio in my opinion. So that is in essence the difference between a debit versus credit spread, is really the difference between buying a call and selling a put versus buying a put versus selling a call. So when we're talking about debit spreads, again, the point of a debit spread is to help offset the costs of the long call or a put. Now, when you follow the methodology that we typically recommend for a debit spread, you can usually reduce the cost of buying that call or put by about 10 to 20%. Now, the rule of thumb for trading debit spreads is you generally want to choose expirations that are greater than 1 month. The same method that we typically use if we're just buying an outright call or a put. We'll always buy an at-the-money call or a put, so about a 50 delta call or a put, and we'll also always sell an out-of-the-money call or a put. Generally speaking, we use about a 15 delta. A 15 delta represents the strike price that's roughly 1 standard deviation away. And the reason that we want to sell something 1 standard deviation away is because that's something that's relatively far away, but actually still has enough premium to offset the cost of buying that long call or put by about 10 to 20%. So you're basically saving yourself you're getting about a 10 to 20% discount on the long call or put, while not really capping the potential rewards of that trade. On a credit spread, exactly, it's different, because what you're doing is you're trying to receive a credit by selling that at-the-money call or put, but because selling that at-the-money call or put has too much risk, you want to buy that out-of-the-money call or put to cap your risk. So what we find is that when you're selling a call or put, you generally want to sell short-dated options to maximize theta, less than 1 month out. You always want to sell the at-the-money call or put. And then what we generally find from our research is that to have the maximum yield on a credit spread, you want to buy back about a 25 delta call or put. So an out of the money call or put, but not as far out as you would if you were buying as you were selling on that credit spread. And if you follow these types of rules, what you'll generally find is that the credit that you receive will roughly be 1/3 of the width of the vertical. So before, in the examples that we were giving, you were selling a 100 strike put, buying back a $90 put. That's a vertical width of $10. And what you want to do is receive roughly 1/3 of that. So in the example before, we were collecting $3 out of a $10 wide spread. So that's roughly 1/3 of the width. That is the type of strikes that we typically will utilize for a credit spread. So again, this is not meant to be a webinar on what are the best, how to best trade a credit or a debit spread. This is more about understanding the fundamental difference between the two. If you want to learn more about the actual mechanics of buying debit spreads and selling credit spreads, we do have separate webinars just on that alone. So please take a look at that. So one other thing that I want to point out that's fundamentally different between trading debit versus credit spreads is whenever you're trading options, you have a trade-off between probability and risk to reward. And these two have opposite relations, meaning the higher the probability, the worse the risk to reward. The better the risk to reward, the worse the probability. And debit and credit spreads sit at opposite ends, as you can imagine, because it's really the difference between buying a call versus selling a call, or buying a put and selling a put. So debit spreads typically have low probabilities of profit. Many times you'll see probability of profits in the 30 to 40% range, but what they have is very good risk to reward. You're risking roughly 50 bucks to try to make $100. So if you're wrong, you lose $50. If you're right on the trade, you make $100. But that's not going to happen as often. Conversely, if you sell credit spreads, it's just the exact opposite. You might, for every $100 in reward that you collect, or $100 in income that you collect, you're risking $200 on the back end of that. But they have higher probability of profit. So you might win more often than not, but in the lower chances that you lose more money. So it's not like one is better than the other. I tend to get a lot of questions around which one's better. One is not better than the other. They're just different in nature. One has lower probability with better risk reward. The other one has better probability with lower risk reward. Now, if that is a concept that you feel that you can understand, please type 9 into the chat window, because this is actually a really fundamentally important understanding of options trading that everyone needs to wrap their head around. And I say this because I still get a lot of questions from users saying, why do you trade something with a low probability? Or why can't you help me scan for stuff that have 90% probability? And the answer is, if you just look at probability, you're missing half the picture. If you're only focusing your attention on trying to get high probability trades, what you're not capturing is the fact that you're probably trading stuff with really poor risk to reward ratios. So don't just focus on probability, look at the balance between the two. And I will show you how options play helps you find that balance in a few minutes. So important to understand the relationship between probability and risk to reward. Don't just seek trades that have high probability, because I know that sounds good on paper. Everyone wants to win all the time, but if you win all the time, that one chance that you lose, you likely are going to lose far more than the amount of money that you've won on the last few steps. So, because debit spreads is like buying calls and puts, they are useful for when you expect a large or quick move in one direction, meaning you either think the stock is going to make a big move to the upside, or you think the stock is going to make a big move to the downside. That's when you want to sell, that's when you want to buy a debit spread. This is useful for when the stock breaks out to all-time highs when you think it's going to run away, or breaks down below a major support level when you think it's going to come crashing down, or if the stock rebounds off of a support or resistance levels and you think you're going to get a very quick move off of that support or resistance level. Now, it is generally speaking that this strategy is better for lower volatility environments because it is a long volatility trade. If this volatility expands, debit spreads will actually be able to capture that. Credit spreads, on the other hand, exact opposite, just like selling a call or selling a put. This is useful for when you expect a neutral or modest move. So yes, you can make money on a credit spread if the stock makes a big move, but if it makes a big move, you are better off buying that debit spread. So if you're expecting a big move, credit spreads are really not the right trade for you, because you're not going to be able to capture all that upside, because it doesn't matter whether the stock moves 1% in your favor or 20% in your favor. You make the same amount of money on a credit spread. These are generally good for overbought or oversold conditions. So if a stock is near oversold and you think it's going to reverse lower, that's a good time to sell a call credit spread. So if a stock is near some kind of oversold area and you think it's going to come crashing back down, that's when you want to sell that call credit spread. And when the stocks are oversold, oversold, and you think it's near a bottom, that's when you want to sell a put credit spread. So call credit spreads near the top, put credit spreads near the bottom. And lastly, credit spreads are better in higher volatility environments. But what I want to show you guys on the next slide is that in itself should not be the primary reason as to why you trade this. Again, credit spreads are better in high volatility environments. Debit spreads are in low volatility environments. Now, before I talk about this next concept, how many of you have been taught or have learned that when vol is high, you want to sell; when vol is low, you want to buy? If you've been taught that, please type yes into the chat window. If you haven't been taught that, please type no. I'm curious as to how many of you have learned that, and how many of you have never heard of that. So I've seen quite a few yeses. A lot of no's, which is okay, and that's perfectly okay. But I do see a lot of yeses. And what I want to show you is that, yes, while this statement is true, the opposite is not true. The opposite is not untrue. What I mean by this is because whether you're trading a debit or a credit spread, your biggest exposure is not to Vega, because when you're choosing your strategies based on volatility, you're basically saying Vega is more important than anything else. But in reality, regardless of whether you trade a debit or a credit spread, your delta exposure is far, far larger than your volatility exposure, which means that even if you sell a credit spread when volatility is really high and volatility does come down, the amount of money that you make on that one component of the trade does not come close to the amount of money that you can make if the stock moves in the direction that you expect it to. Or if the stock moves in the opposite direction that you expect it to, it's going to far outweigh the money that you make on the volatility piece. And this is something that it's hard to convince people of this, because it's hard to actually show you real numbers. And that's why I want to use options play to try to show you this last piece. But if that, for those of you that answered yes, I'm curious as to see if what I just said right now makes sense to you, that the delta component of your credit versus debit spread is larger than the volatility component. If that makes sense, please type yes. If that doesn't make sense, please type no. Okay, some yeses, some nos. I don't expect everyone to have just take my word for that, but I want to put this in your head. For those of you that have been taught, sell vol when it's high, buy vol when it's low, yes, that statement is generally true. But if you start selecting your strategies based on just on that one criteria alone, what you're doing is you're basically trying to suggest that your Vega exposure is larger than your Delta exposure. But what I'm trying to suggest is that your Delta exposure is much larger than your Vega exposure. So what I'm trying to say is that your directional view should just help you decide whether you trade debit versus credit as opposed to your volatility view. Okay, so before we move over to options play, I want to show you one last chart. When we trade debit spreads, we want to trade them when we expect a big move. So here's a stock that was trading within a large triangle, and it was trading within a smaller triangle, and finally started to break out. So when this breakout happened and you expect a move to break out, that is an opportunity of when you should want to consider buying a debit spread. Conversely, for those of you that sell credit spreads, these types of conditions are more suitable. When a stock is kind of just range bound, many times you might use these technical indicators to determine these overbought, oversold conditions when they're near a bottom. Those are the types of conditions where you want to sell a credit spread. So in this particular case, what I'd want to do is I want to buy maybe a call debit spread when the stock breaks out. But then when it's near a bottom, I want to sell that put credit spread near these bottoms. And I want to sell call credit spreads near these tops. Because as long as the stock doesn't break out of these support or resistance levels, I can make money. So I don't need a big move to make money on the credit spreads. I actually want the stocks to stay neutral versus a debit spread. I need a big move in order for that to be profitable. So what that means is that if you're trading a debit spread, chances are you're not going to trade a debit spread multiple times on the same symbol in the same year, because breakouts like this, they don't happen all the time. They actually happen fairly infrequently. So if you do trade debit spreads, you're constantly trading new symbols all the time. Versus credit spreads, you might find yourself actually trading credit spreads on the same stock multiple times within a very short time span. So it's actually quite different in nature between these two. So again, this is all meant to just help illustrate the fundamental difference between trading a debit versus credit spread. So let's now go back to options play. I want to show you some examples of this, because at the end of the day, I don't expect you to just take my word for it. I want to show you some real ideas and show you why certain times you want to trade debit spreads and certain times you want to trade credit spreads. And then at the end, what I'll do is I'll try to do a quick lightning round, let you guys submit some symbols and see what you want to do. So Bank of America, I was looking at this stock because this stock just broke out to all-time highs. Set a new 52-week high today, broke out above a major resistance level at 31. I think that this stock has some room to potentially break out to the upside. So as you can see, this was a major top for since April of this year, 31 bucks. It hit that price, bounced off. Hit that price again, bounced off, and just broke above it. So there's a few ways you can look at this, but I think my views are, I think this stock can take off. So that's where I think it makes more sense to buy a debit spread. But let's compare the debit versus credit spreads to show you why debit spreads make more sense in this particular example if you do think that this stock is going to take off. So in order to do that, I'm actually going to use options play. I'm going to compare a debit versus credit spread and show you side by side. Don't take my word for it. So what I'm going to do is I'm going to select a credit spread here, short put vertical. I'm going to select an expiration and strike price that makes a little bit more sense here. So let's say I sold the $31.50, $30 credit spread. So this is a $1.50 wide credit spread. I'm selling the 31.5 puts. I'm buying back the 30 puts to help protect myself to the downside. This collects $46 in income while risking about $104, about 1/3 of the width, versus buying a debit spread if I think the stock is going to move higher. So again, because I think the stock's going to make a big move, I'm suggesting that you should trade the debit spread. But again, don't take my word for it. Let's put up the credit versus debit spread and let's actually see. Now, before we actually do this, what I want to do is I want to make sure we're comparing apples to apples here. So let's say I'm willing to risk $1,000 on this trade. What that means is I can sell 9 contracts of the credit spread and I can buy 9 contracts of the debit spread. So both of these, as you can see, max risk 918, max risk 936, almost the same amount of risk. One, I can only make $414. The other one, I'm making $1,332. But it's very different from each other. So, as I said, I think the stock's going to make a big move. So if it does make that big move, let's say it moves up to $33. As you can see here, if I sold the credit spread, I make a $414 profit. Versus if I bought the debit spread, I make an $882 profit. So this is my point about volatility. If Bank of America was relatively expensive from a volatility perspective, I hear from a lot of users that will say, well, it's better to sell a credit spread. Well, my point is that even if volatility is really expensive and you get this depreciation in volatility, what you're going to see is that the difference in terms of profits in volatility might come down to maybe $50 on a $1,000 trade. And this is talking about a massive move in volatility from 21 down to 16. Notice how this changed from about $750 to about $800. Not a big move. Versus if this stock even goes from $33 to $32.50, I go from $800 down to about $392. That 50 cents in the change in the underlying price has a far larger impact on whether I make or lose money on the trade versus if the stock makes a big move in volatility will only impact a fraction of my trade. So that's my point, is that the stock moving is going to have a much larger impact on your P&L than volatility. So if you start selecting strategies based on just volatility alone, you're likely going to severely underperform in the long run, because if you do expect the stock to move to $33, it's clear that you want to trade the debit spread. I'm going to make almost double the amount of money than if I sold the credit spread. Conversely, if my outlook on Bank of America was different, if let's say my outlook was that I think this stock is going to just move sideways, maybe I think the stock might even pull back a little. Maybe I think it just might pull back to that 31 level. Maybe it might move back up a little, but I don't really, maybe you're not as bullish on financials, but you recognize the fact that it broke out to all-time highs, so you think 31 is a major support level, and you don't think it's going to go below 31, so you sell that put vertical. So if the stock stays around that 31 level, or 31.50 level, here I make $414 versus if I bought the debit spread, I lose $349. So again, your outlook, your directional view should trump any type of views on volatility, because even if I'm completely wrong on volatility, the impact of that is not going to be major to my portfolio, versus if I'm wrong on my delta, I can severely underperform one strategy over another. So I hope that that makes sense to you. But this is what the tool allows you to do, is compare debit versus credit spreads, look at your outlook on the underlying stock. Do I think the stock's going to make a big move to the upside? Do I think the stock's going to move up to $33? If I do, then this tool helps me decide which strategy should I trade. Do I think I should trade the debit spread because it'll make me a certain amount of money depending on how far I think the stock's going to move in a certain amount of time? Or should I trade the credit spread here so that you can quickly, so that you can utilize or you can make money if the stock doesn't move at all. So this is the only strategy that allows you to make money if the stock doesn't move, is selling a credit spread. So if you do believe the stock's going to move, not going to move, you should sell that credit spread. But if you do get that big move, you don't make any more money. And that's why, again, I'm advocating that if you're going to make a choice between debit versus credit, base that decision based on where you think the stock's going to go, not based on the outlook of the stock. Next, I'll take a look at Cisco, and I'll do this really quickly because I want to let you guys submit some symbols. So while I look at Cisco, why don't you guys submit some symbols? Submit a symbol, whether you're bullish or bearish on it, and let's take a look. So Cisco, an interesting trade because it's overbought on a technical indicator perspective. It just hit a resistance level and bounced lower. These are all the things that both credit and debit spread traders probably look for. So you could be in both camps, right? So I think Cisco is a prime example where you're saying that it's overbought. You think it might move a little lower, but you don't necessarily know that it's going to go all the way down to significantly lower. But as long as it stays below this $48 resistance level, you can make money. So here's a prime example of where I think it makes sense to compare a debit versus credit spread. So let's say I'm bearish and I want to sell a call vertical. So let's say I sold the 46 and I buy back, let's say, the 49. And then what I'm going to do is, again, I'm going to compare apples to apples. So let's say I'm willing to risk $1,000 on this trade. As you can see here I'm risking $835. Here I'm risking $756, roughly the same amount of risk. So now let's take a look at Cisco. Cisco's trading at about 46 bucks, right here around that support level. Let's say the stock doesn't move any lower, it just sits around the support level. On my credit spread, I make $294. On my debit spread, I lose $585. Not a good look. Conversely, if the stock does break below that 46 level, as you can see, even if it moves down to 45 or 43, I can make a substantially more profit by just trading that debit spread, just a couple of bucks lower, even 44. I start severely outperforming. So before I was saying 46, this loses 600 bucks, this makes 294. Notice how big of a difference that couple of bucks makes on this particular trade. Here I'm making 415, this is 294. Big difference. That's what my point is, that your delta exposure is much larger than your volatility exposure. Even if you get volatility spot on, the difference in terms of the two positions with a huge change in volatility here is 20-30 bucks, versus if the directional exposure is wrong, or if your directional exposure is inconsistent, you could be off by a few $100 bucks, maybe even a few $1,000 bucks, because if the stock's down at 42, here I make $989 versus only 282. So I've seen a lot of users will say, well, Cisco, volatility is really high. I should sell credit spreads. I'm not going to buy the debit spread. Well, if you did that, you've capped your rewards at $282 when you could have made $1,000 when you bought the debit spread, even though volatility was high. Because if you do think the stock's going to make a move to the downside, debit spreads are far better at taking advantage of it, because if you think the stock's going to make a big move lower, what would you do? You would buy a put. You wouldn't sell a call. And that's the fundamental difference between a debit versus credit spread. So I hope that I've been able to make that clear. What I'll do is I'll take a few seconds to go through some bullish and bearish ideas that some of you have submitted. I'll try to go through as quickly as possible. Lauren says he's bullish on CGC, Canopy Growth, marijuana stock, maybe starting to form a bottom here. I don't think that's happening here. I think there's more downside to marijuana, but Lauren wants to take a look at some bullish ideas. I don't know how bullish you are, Lauren. If you can put in a target price here, that'd be great. But I actually think that if you're going to trade this, a short call, bullish short put vertical, I'm not sure you're going to be able to find a lot of short put verticals that make sense here, but let's take a look. Actually, you might be able to find some good ones here. So let's compare these. Let's say you're willing to risk $1,000. Let's take a look. So the stock's trading at 21.66 right now. Let's say the stock modestly rallies up to 24 bucks. If it does, the credit spread makes 456. The debit spread only makes 385. So here, obviously, even a modest rally up to $24, you're still getting better returns on the credit spread. But if you do think that this stock's going to rally back up to 28, clearly, look at this, 456 versus $1,600. Which one would you rather have on a rally here? So ask yourself, Lauren, are you super bullish on CGC? If you are, buy the debit spread. If you're not very bullish, you think it might move a little bit, sell that credit spread. Jake is bearish on UPS. 114, strong stock, but starting to look like it's got this kind of head and shoulders formation here. What's interesting about head and shoulders is that you get a really clear target, you know, about this 107 area. So yes, I think that you're better off selling buying a debit spread, but let's not take my word for it. Let's compare the two. Let's say I'm willing to risk roughly, again, $1,000. Let's compare the two. If the stock does decline to that 107 level, that's what I love about these head and shoulder formations. Looks like a pretty nice topping formation starting to turn lower. If you sold the credit spread, you make $342. Not very exciting. Buying that debit spread, $1,500. Now, I will say, if this doesn't break that 112 level, let's say it stays above 112, here you're better off selling that credit spread. So ask yourself, how bearish on you are on UPS? If you're mildly bearish, sell that credit spread. If you're even remotely more bearish and you think it's going to make that big move, look at how big the difference in profit is. 342 versus 5 times that, $1,500. So use your directional view to decide whether you trade debit versus credit spreads, not your volatility view, because even if you're spot on volatility, you're going to make an extra maybe $50 on this trade. It's not nearly as much as the almost $1,000 or more that you'll make on that one. So I see a lot of tickers, but you didn't put bullish or bearish, so unfortunately I'm going to have to skip that. Larry is bullish on Roku. Roku really kind of forming a bit of this, I don't know, consolidation, let's call it that. And let's just say you do get a rally higher. So, I see this as kind of maybe a consolidation, and you do get that push back up to that 158 level. Here, unfortunately, debit spreads don't look very attractive, and that's because they don't list strikes high enough. So maybe let's go out to December. Oh, they have higher strikes here for December. So let's look at that. Let's say we buy a 135, 165 debit spread, and then we sell a credit spread here. Let's say we sell that 132 and we buy back maybe a, I don't know, 119. This is a pretty volatile stock. Let's say we're willing to risk about $1,000. And let's take a look. Roku's trading around 128 right now. Let's say it just moves modestly higher. Let's say it stays in this consolidation range at 135. Clearly, selling that credit spread is the only trade to make. But if you have any inkling that this stock's going to make that big move back up to 153, 155 maybe, as you can see, instead of making 565, you can make roughly double that with the debit spread, risking the same amount of money, 935 versus 910. So we're always comparing apples to apples here. So we're risking the same amount of money. Would you rather make $1,100 or 565 if you do think the stock's going to move up to 155? That's why I'm telling you, use debit versus credit spreads. Use your views on the stock to figure out whether you are bullish or bearish. Saint Germain, SAAI. I'm actually not familiar with this stock, but clearly very strong stock. 1 month and 6 month trend is bullish. Ideally, I would have bought it right here around this 91 area, but we've already got a push higher. Looks like it's got support around this 97 area. So I think this is a prime candidate for comparing debit versus credit spreads, because there's two ways I can view this. I can either say 97 is a nice support. I don't think it's going to go below it. Or I can say I really think the stock's going to take off. I don't know which camp you're in, but if the stock does stay within that range, let's say I want to risk roughly $1,000. If I think the stock is just going to stay above 97, so let's say I think the stock's going to just stay around 99, I clearly want to sell the credit spread. Now, I don't know that that's the best credit spread to sell. But there are not a lot of choices here. These strikes are really far apart. So some of these smaller cap names, I wouldn't necessarily trade this because the strikes are too close to each other. But if you were able to find one on some of the weekly options, which I don't think are listed on this particular stock, I think you get the point of how to compare whether you should sell that credit spread or you want to buy that debit spread. It really depends on how bullish you are. I'll take one more example before I open this up for Q&A. I really appreciate you guys taking the time out to submit some symbols. So Jim is asking CZR. Caesars Entertainment. We couldn't even find a debit spread here on this particular stock, so I'm not going to use that. Let's see. I'm trying to find some larger cap names. Zymeworks. Let's see. These are some pretty small cap names. Many times on these small caps, you can't really find the right trades to make. These aren't all great examples, but let's take a look. Say I'm willing to risk $1,000. This stock, really broke above this let's just call it a $30 resistance level. That's now support. So do I think this stock is going to move significantly higher? The stock certainly does tend to make big moves. Looks like it made about a $6 move in the last month or so. So let's say I do think that this could move another $6 to the upside. As you can see here, if you sold the credit spread, you only make $140 versus buying that debit spread. You make $410, triple that. You know, versus if you do think it's just going to stay around that support level at 31, 32, clearly you want to sell that credit spread. So again, so many more examples. I unfortunately don't have enough time to go through all of them, but I hope that this illustrated to you guys truly the fundamental difference between buying a debit versus credit spread. If you feel that you understood what the fundamental difference between a debit versus credit spread, please type yes into the chat window. If you feel that you still haven't you still don't feel that you understand that, please type no. I'm open to criticism. I'm open to feedback as well. So if anyone feels that you still don't quite get it, please type no. Okay, I see a few no's. Michael, if you have more questions, I really welcome you to continue to submit your questions to us using this questions ask us section on your application. If you have continuing questions regarding this, please send us your questions. I'm happy to try to answer as many questions as possible. And for now, please, if you have questions regarding anything I discussed here today, please type them into the chat window and I'll try to answer as many questions as I have time for here today. So I will try to answer as many questions as I have. Looks like a few questions already up there. Molly's saying, could you consider high volatility as indicating chance of large price movement? Possibly, but not really, because volatility tends to be more of a backwards looking thing, meaning if things move a lot, you have high volatility. It's really more of an expression of what's happened in the past rather than what is likely going to happen in the future, because the market, generally speaking, is not any better at predicting whether stocks will move in the future or not. So I don't generally believe that to be the case. Jake is saying, can you send the web so that we can review? Jake, we have, okay, great question. So for those of you that want to learn more about the credit versus debit spreads, I just sent a link to everyone in the chat window so that you can view our YouTube channel. And I have a video here on maximizing income with credit vertical spreads and maximizing your profit for debit vertical spreads. So we just focused on one. So if you want to learn more, I highly recommend you to take a look at those videos to learn more about debit versus credit. Eric is asking, can you please comment on the best rule of thumb to use when deciding on the strike width to use when selecting a spread? So Eric, I do talk about that in detail during these two webinars. So if you want to learn more about the rule of thumb for selecting strikes on credit spreads versus debit spreads, just please view those videos, and I do go into those in detail. Larry, you're very welcome. Majid is asking, when you talk about volatility, do you mean VIX or Vega for the stock? I'm talking about the implied volatility of the stock when I'm referring to volatility. Ed is saying, what does the colored ring signify, and what about the numbers inside? Great question, Ed. Ed's asking about these options play scores. So the options play score is telling you the risk to reward. So think about the amount of green that you see on this P&L chart. That's your potential reward. And the amount of red, that's your potential risk. And what we're really looking at is how much green is there on that chart versus how much red. The more red there is, the lower the options play score. The more green there is, the higher the options play score. It's really looking at the risk to reward balance with that probability. So before I talked about the relationship between probability and risk to reward. And what this is really trying to tell you is how well balanced these two actually are, because what you can do is you can have trades that are very heavily skewed to probability that look good on paper, but actually have really poor risk to reward. So the options play score is looking at how well balanced these two metrics are. The better they are, or the better skewed they are in your favor, the higher the options play score. The worse they are skewed in your favor, the less they are. So look at how little green there is on this particular chart. That means that you don't really have a lot of opportunity to make money, because look at this. What this means is that by December 20th, this stock needs to be at $34.50 or higher in order for you to make money. That's all the way up here. So the stock needs to get to that point just to break even, meaning it has to go above that to make any real money. And what we're seeing is that the chances of that happening are relatively low. That's why you have a low options play score here. I hope that answered your question. Dan is saying, how responsive is this to the earnings season, i.e. Amazon big drop after earnings? So that, because you can't trade options after hours, the first thing you can do is tomorrow morning. So when the market opens up tomorrow morning, you'll be able to analyze the most recent option quotes in the morning. That's how responsive is. As soon as the market opens, you'll be able to. By tonight, you will be able to analyze Amazon on options play to see the big drop, but you're going to have to wait till tomorrow morning to see where the options open up. No one knows where the options are going to open up until tomorrow morning. Are you using Black-Scholes algo to calculate values? Yes, we're using Black-Scholes to estimate what the future value of an option is prior to expiration. Any tips, S. Roy is asking, any tips on how to select good risk-reward ratio in credit spreads? So the risk-reward ratio that we find for credit spreads is very simple. You want to collect 1/3 of the width of the spread. That is the golden ratio of a credit spread. So again, if you want to learn more about that, I highly recommend you to take a look at our video on maximizing income with credit vertical spreads. John J is asking, how can you use debit spreads to take advantage of earnings? Well, from my perspective, it doesn't matter whether earnings is coming up or not. You can use debit spreads to take advantage of a directional view. So if you have a directional view and you think a stock's going to make a big move, you can use a debit spread. You can use them regardless of whether earnings is coming up or not, in my opinion. Any recorded video webinar you have on this topic? I'm not sure which topic you're referring to, so we will send you the recording right after we're done here in about 30 minutes after we finish, so I highly recommend you to take a look at that. What is the maximum options play score? It is 250, Stephen. Any other questions? I know I covered a lot of things here today, and I know I went relatively quickly because I did have a lot of content to get through. So I just want to make sure everyone understands the difference between debit versus credit spreads, and I hope that you guys were able to find some insights into this. And I hope that this, at the very least, the next time you think about placing a trade, you think twice about which one is best suited for you based on what your outlook on the underlying stock actually is. So, Jake, thank you so much. Lewis, thank you so much. I really appreciate everyone taking the time out here this afternoon, attending, submitting your questions, participating, and letting me know that you are understanding the concepts. I love doing this because I really find passion in being able to teach users how to utilize options correctly, as opposed to what you just read on the internet. And I hope that I'm able to teach you not only using a visual format, using the slides, but more importantly, showing you the actual numbers so that you can actually see the difference between credit versus debit spreads, because they are very different. Because there are some times where you can make 5 times the amount of money if you correct the right trade versus just using volatility as your directional view. So I hope that was clear to you guys. I thank you so much again for participating every single week. I hope that you guys have found this useful. I'll send you the email with the recording and the slides in about 30 minutes. So please look out for that. Take a look at the webinar recordings. It is useful in helping you better understand how to utilize this tool. So thank you so much. I hope you guys have a great afternoon, and I will see you guys next week.